Welcome to the video. Today, we're going to discuss one of the most important concepts in trading, liquidity. A few weeks ago, I had the opportunity to meet a hedge fund manager in the UAE. He manages large amounts of capital for major investors and companies, so naturally, I was curious about how professionals approach the market. I asked him, what is the single most important factor you consider before taking a trade or making an investment? He told me, every trade I take is based on liquidity and nothing else. That answer stuck with me because it reveals a truth that most retail traders overlook. While many traders focus solely on indicators, patterns, and predictions, the biggest players in the market are focused on one thing: where liquidity is resting and where price is most likely to go to capture it. And that's exactly what we're going to uncover in this video. First, let's take a look at these setups. This setup, and even this setup. All of them are based on one core concept: liquidity. So let's first understand what is liquidity. Liquidity, in its simplest form, is just the availability of orders in the market. Wherever a large cluster of orders is sitting, that area is considered a liquidity pool. Now here is where it gets genuinely fascinating and slightly uncomfortable for retail traders. Every single time you place a stop loss above a recent high or below a recent low, which is exactly what every trading course, every YouTube video, and every textbook tells you to do, you are unknowingly contributing to a liquidity pool that institutional players are actively hunting. Think about that for a moment. The same logical, textbook stop-loss placement that you were taught to protect your capital is the exact same level that smart money is targeting to fuel their own entries. Equal highs on a chart, two or more peaks sitting at roughly the same price level, represent a massive pool of buy-stop orders from traders who are short and place their stops just above those highs. Equal lows, two or more troughs sitting at the same level, represent a massive pool of sell-stop orders from traders who are long and place their stops just below those lows. Trendline liquidity forms when price respects a diagonal trend line repeatedly, causing retail traders to stack their stops just beyond it. Every touch of that trend line adds more orders to the pool, and institutions know this better than anyone. Institutions need liquidity to fill their enormous positions. When a major bank wants to place $1 billion buy order, they need $1 billion worth of sellers on the other side. They cannot conjure those sellers from thin air. So what do? They engineer the conditions that force retail traders to sell. They push price deliberately into areas where they know clusters of sell-stop orders are sitting, below obvious swing lows, below equal lows, below respected trend lines, triggering those stops and creating the flood of sell orders they need to fill there by positions at the best possible price. This is called a liquidity sweep or a stop hunt. And once they have collected all those orders and filled their institutional positions, price reverses sharply and aggressively in the opposite direction, leaving retail traders stopped out and completely confused about what just happened. Sound familiar? Of course it does, because it has probably happened to you multiple times, and you blamed yourself for bad timing when in reality, you were simply unaware of the game being played around you. Let's get specific, because knowing the concept is one thing, but being able to spot it on a live chart in real time is what actually makes you money. The first and most important type is buy-side liquidity. This sits above swing highs, equal highs, and previous session highs. This is where short sellers have placed their stop losses and where breakout traders have placed their buy orders anticipating a bullish breakout. Institutions target this pool when they need to offload their long positions or build short positions at premium prices. The second type is sell-side liquidity. This sits below swing lows, equal lows, and previous session lows. This is where long traders have placed their protective stops. Institutions sweep this area when they need to fill massive buy orders at discounted prices before launching price higher. The third type is trendline liquidity, which we touched on earlier. The diagonal pools that form when retail traders religiously draw trend lines and stack their stops just beyond them. And the fourth type is old highs and old lows from higher time frames. Weekly and monthly levels where enormous amounts of orders have accumulated over long periods of time. These are the most powerful liquidity pools of all, and when institutions target them, the resulting price movement is explosive and fast. Here is the most important mindset shift you need to make after watching this video, and it is completely free, so please write it down somewhere you will see it every day. Stop placing your trades where everyone else is placing theirs. The moment a setup looks obvious to every retail trader on the planet, the trendline bounce, the double bottom, the break of equal highs, that is precisely the moment you need to pause and ask yourself whether you are actually seeing opportunity or whether you are about to become the liquidity that funds someone else's trade. The market is not random. It is not chaotic. It is engineered with ruthless precision to move toward areas of maximum liquidity before reversing.